Welcome back to PhatBear Pod. I'm your host, PB. Boy, you wouldn't believe what happened yesterday with Hyperliquid. The action was sucking most of crypto Twitter into it. HLP was down more than $12 million in unrealized losses one point, and there was rumor that Binance was behind it. I'll tell you all about the spicy story later. But first, let's start with Bitcoin price action. Bitcoin's hanging out around 87K. Give or take a few $100. It's like it's stuck in a bad sitcom rerun. Same old range, no plot twist, just teasing us with dreams of 90K while I stare at my 2021 bags and wonder where it all went wrong. The total crypto market cap's sitting pretty at $2.85 trillion, which sound impressive until you realize half of that is probably tied up in meme coins and projects with white papers written in crayon. Meanwhile, the 24-hour trading volume's at $78.46 billion, up a couple billion from yesterday. That volume tells me nobody's got the guts to make a big move. Bitcoin dominance? It's ticked up to 60.8%. Because of course it has. The king just keeps flexing while the altcoins scramble for crumbs like pigeons at a picnic. I'd cheer, but I'm too busy kicking myself and not selling at the top again. And then there's a fear and greed index, down one measly point from yesterday to 33. The top gainers of the day are Curve, Zeta Chain, Maker, and Beam. The top losers are Hyperliquid, Movement, Pancake Swap, and Nillion. On the macro front, Bank of Japan Governor Kazuo Ueda steps up to the mic this week, adjusts his tie, and basically says, hey, if inflation keeps flexing its muscles, we're going to hike rates like it's our job. Which, it kind of is. On March 26th, he told Parliament that the BOJ is ready to crank up interest rates if food prices keep climbing and start dragging everything else, services, goods, you name it, into a big, messy inflationary party. This comes after Japan's core inflation hit 3% in February, way above their precious 2% target, and it's been overstaying its welcome for nearly 3 years now. Ueda's playing it cool, saying underlying inflation's still just a bit shy of 2% when you strip out the wild cards like food and fuel. He's betting on a tight job market and wage hikes to push it there naturally, like some economic fairy tale. But then he drops the real tea. If food costs keep spiking and spark a chain reaction, they'll have to act. Translation, we're not hiking rates yet, but we're keeping the bazooka loaded. Meanwhile, I'm over here wondering if my grocery bill is going to be the thing that finally breaks the yen. Next up is our crypto news. GameStop, the video game retailer we all thought was doomed to fade into blockbuster oblivion, just announced that their board unanimously updated their investment policy to include Bitcoin as a treasury reserve asset. That's right. After years of being the poster child for meme stock mania, they're now taking their $5 billion cash pile and saying, hey, maybe we should park some of this in Bitcoin instead of letting inflation nibble away like a pack of rabid Pac-Mans. The filing's got all the juicy disclaimers you'd expect. Bitcoin's volatile as hell. This might blow up in our faces. And we're not capping how much we might buy or sell. They're diving in headfirst, but with a parachute labeled, "Don't sue us." Investors loved it though. Shares spiked 6% after hours, then kept climbing, hitting over 16% by Wednesday. This Bitcoin move is their Hail Mary to stay relevant. Inflation's eating their cash at 10% a year. That's $500 million gone if they do nothing. So I guess they figured, why not roll the dice on BTC? Fidelity, the Boston-based behemoth that's been flirting with crypto since they started mining Bitcoin back in 2014, is now in the advanced stages of testing their own stablecoin, and it's pegged to the US dollar. Because of course it is. What else are you going to peg it to? Dogecoin? They're saying it'll act as digital cash for crypto markets, backed 1-to-1 by U.S. treasuries or cash equivalents, just like every other stablecoin trying to elbow its way into the $240 billion market. Yawn, right? Except it's Fidelity. So suddenly everyone's acting like it's the second coming of Satoshi. Fidelity's digital assets arm is running the show, and they're framing this as a play to revolutionize finance. Tokenized assets as collateral for trading margins? Sure, sounds sexy, but the stablecoin market's already a crowded bar fight. Tether's got $144 billion locked up, Circle is flexing its compliance cred, and now every bank and their grandma wants a piece. Trump's World Liberty Financial just dropped USD one this week too. Fidelity's late to the party, and I'm over here wondering if they're bringing anything new or just a fancier bottle of the same old whiskey. So, Ross Ulbricht, freshly pardoned by Trump in January after 2 life sentences for running Silk Road, decided to dip his toes back into the online shopping game this week. He fires up eBay, maybe to snag a drum set for his old Penn State vibes or just some socks after a decade in prison duds, and gets hit with a digital equivalent of a no-shirt, no-service sign. Account stalled, no explanation, just eBay flexing its gatekeeper muscles. Ross, being the legend he is, hops on X and drops a zinger. eBay won't let me in. Guess I'll just have to build my own marketplace. The crypto crowd's losing it on X. Silk Bay incoming. With folks like Zeus Ellen offering to help build a Bitcoin-powered storefront that could make PayPal obsolete. Picture Ross Road. Legit goods, blockchain rails, maybe some artisanal coffee instead of cartel shipments, tapping into that massive billion stablecoin market. Time for some spicy DeFi news. Hyperliquid, the hotshot perps exchange, was minding its own business, raking in billions in volume, when a trader decided to turn their HLP vault into a personal punching bag. On March 26th, this mystery whale opened a massive 6 to 8 million short position on JELLYJELLY, a Solana-based meme coin with a market cap smaller than my grocery bill. Then, they flipped the script, bought up Jelly on spot markets, pumped the price from 10 million to over 50 million in an hour, and forced their own position into liquidation. Here's the kicker. The HLP vault, bless its naive little heart, had to cover that short. Unrealized losses spiked to 12 million as Jelly soared. If that meme coin had hit a 150 million cap, poof, tens of millions gone, the vault's toast, and Hyperliquid's sipping ramen broth instead of champagne. X lit up with panic, screaming that HLP is going to zero out. And the DeFi crowd started whispering Terra Luna and FTX at the same time. The whale wasn't done, though. They were playing both sides, longing Jelly on other exchanges to hedge their bet. Ruthless? Yes. Right as Jelly's mooning Binance and OKX, those centralized sharks, list JELLYJELLY perps like they've got a crystal ball. Coincidence? I think not. Crypto sleuth Zach XBT tracked the whale's wallets, fresh deposits from Binance and OKX, and the dots started connecting. Was this a Binance insider? A funded puppet? The Hyperliquid's team scrambled like headless chickens. They forced closed the Jelly market at a laughable $0.0095. Way below the 50 cents Oracle price, delisted it, and somehow clawed back a $700K profit when the dust settled. Talk about snatching victory from the jaws of a train wreck. The ex-peanut gallery went wild, some calling it a masterclass in manipulation, others screaming centralized collusion. Hyperliquid's co-founder fessed up on Discord. Yeah, we got played, but we're fine, vault safe. Hyperliquid dodged a bullet, but their invincibility took a hit. JELLYJELLY is back to obscurity. Market cap's a measly 5 million now. And the whale's probably laughing all the way to the bank, or at least a yacht in the Bahamas. DeFi is supposed to be trustless, but this was a reminder that the house always has an edge, whether it's a smart contract or a sex pulling strings. USDC, the stable coin that's basically the crypto world version of a security blanket, crossed the $60 billion market cap mark this week. It was a measly $30 billion a year ago. That a 100% year-over-year spike, folks. And Circle's been minting new USDC like it's printing monopoly money. Most of that's flowing into Ethereum and Solana, because apparently those blockchains are the cool kids' table now. Why the surge? Well, the stable coin market's ballooning. Total cap's over $240 billion now. Another record. And USDC is gobbling up a bigger slice of the pie. It's still trailing Tether's USDT, which is lounging at $144 billion like the smug leader it is. But USDC is closing the gap. Circle CEO Jeremy Allaire's probably popping champagne, touting trust in digital dollars, while I'm over here squinting at the fine print. Backed 1-to-1 by cash and treasuries? Sure, until another Silicon Valley bank scare knocks it off its peg like in 2023. Remember that 97 cents dip? My trust's been shaky ever since. MIM Spell, the magic-themed DeFi platform tied to Abracadabra Money, got hit with a $13 million exploit. We're talking 6,260 ETH swipe. Poof, gone. Like some hacker waved a wand and said, "Abracadabra, your money is mine now." This wasn't a smash and grab. It was a calculated heist. PeckShield says the attacker used a flash loan to mess with the platform's pricing mechanism, pumping or dumping asset values to trick the system into coughing up more magic internet money. Abracadabra stablecoin. This hack zeroed in on meme pools linked to GMX tokens. Yep, the same GMX that's been a darling of the derivatives crowd. The attacker exploited a liquidation loophole, something called a phantom collateral bug. Basically, they borrowed against positions that were already toast, making the system think there was still value to lend on. By the time the dust settled, 13 million in ETH was out the door, and MIM Spell's team was left scrambling. GMX, bless their hearts, jumped on X to say, "No issues with our contracts, just Abracadabra's cauldron screwing the pooch." Nice dodge, guys. For our airdrop today, we're looking at Keiko Finance. First off, Keiko is a shiny new collateralized deposition protocol on Hyperliquid's HyperEVM. It's over-collateralized, of course, because DeFi loves nothing more than locking up your money to spit out a fraction of it back as stable cash. How do you farm this thing? Step 1, you need some Hyperliquid assets. Hype's the native token, so grab some from Hyperliquid's spot market and bridge it over to HyperEVM. Deposit your Hype or other supported collateral into Keiko Vault. The system calculates how much K, the protocol stablecoin you can borrow based on your collateral's value, and a liquidation ratio. Don't overdo it, though, or you'll be crying when the market dips and you're liquidated faster than a margin call on Binance. Step 2, mint that K. It's your ticket to the farming game. Now, here's where the D-gens get creative. You can take that K and pair it with another token, like USDXL, or even more Hype, and add it to liquidity pools on HyperSwap or KittenSwap. You can also deposit some of your K into Keiko Stability Pool. It's a safety net that absorbs liquidations, and in return, you get a cut of collateral when someone's position goes bust. Higher risk, higher reward. That's it for today's PhatBear Pod. I'll catch you guys tomorrow.